Good morning and welcome. I'm Josh Lipsky, Senior Director of the Atlantic Council's Geoeconomics Center, and we are so pleased to welcome you to our first event of 2025 at the Geoeconomics Center, our Global Economic Outlook event, Trump, trade, and tariffs, everything you need to know about the global economy in 2025. And we could not be more pleased to welcome in the perfect guest for this conversation, Jan Hatzius, Chief Economist at Goldman Sachs, Head of Global Investment Research. Jan, this is the fourth year you've joined us for this kickoff event. It's always of high interest and a really.
So I'm really looking forward to getting right into it.
We feel the same way. Let's jump in. I already have many questions online, so I want to tell the online audience, use askac.org. I will get to as many questions as I can. But Jan, you know where I'm going to start. Let's talk about the U.S. outlook. We've talked about this for the last 4 years. You really had the correct call. I remember debating this in 23 and 24. You called the soft landing. That's what happened. And this year, you're a little more optimistic than the rest of the street. I think your call is about 2.5% GDP growth versus 1.9 for the Wall Street consensus. Walk us through your thinking.
We're at 2.5%. I mean, the consensus has been creeping up, depends a little bit on which survey you look at, but it's probably about half a percentage point above the consensus. We do think that growth this year is probably a little bit slower than it's been the last couple of years, and we're also not quite as far above consensus as we were in 2023, 2024, but it's still a very solid growth pace in our forecast. And I'd say if you look at it from the distributional perspective, recession risk, we also take a pretty upbeat view. We're at 15% for the probability of a US recession in the next 12 months. This is basically where we've been for the last year. We were higher than that in the soft landing camp, but saw a higher risk a year earlier. Over the last year, we've been basically at 15% with a small wobble in the summer when we had this big jump in the unemployment rate in the July employment report that caused us to move up to 25%. But then we reversed that pretty quickly once it became clear that that was a false alarm. And so it's 15% for me is kind of a magic number on recession risk because it's the long-term unconditional average. We've seen a recession about once every 7 years. What are the drivers of this pretty upbeat view? It's basically the existing tailwinds that have been driving the economy forward over the last couple of years. This is still the main tailwind, and I would say real income, real disposable personal income growth is at the top of the list. And it's driven to a large extent by the fact that price inflation has come down a lot more quickly than wage inflation. And so we've gone from a situation where prices were rising very sharply in 2022, 21, 22, and that ate into real incomes to a situation where we have price inflation in the 2 to 3% range. We have wage growth still around 4%. That gives you 1 to 2% real hourly wage growth. Then there is some employment growth on top of that. There are some other drivers of income, and you get 2.5% roughly for real disposable income, similar to our real GDP forecast. We also are getting a bit of a supplement to the spending growth from a positive wealth effect. That's, I think, less important. And obviously, it's more subject to change because it really depends on sometimes shorter term changes in markets. But it's really the real income that drives most of this. Now, of course, there are also a number of policy issues and policy changes that we're going to get into. We haven't made a major change on the back of the election result and the outlook for changes in policy, because we think the growth effects are going to be somewhat mixed. There are some positives that we're expecting from slightly easier fiscal policy, extension of the 2017 tax cut, maybe some additional small tax cuts, and generally industry-friendlier regulatory environment. That's probably also a positive. But then there are some negatives, also with some risks, but even in the baseline, some negatives from tariffs and from a bigger crackdown basically on immigration and therefore slower labor force growth. We're more focused on the tariffs, and I know we're going to get into the tariffs. On the immigration side, ultimately, we think that, yes, we will see further deceleration in net immigration into the US, probably to a rate that's a little below what it was pre-pandemic, but we don't have a dramatic decline into deeply negative territory for net immigration. But it's something we're watching.
So let's talk about a few of the policies you mentioned. And it's interesting you say the Trump policies haven't really affected too much the US GDP outlook in 2025. First, on the tax cuts, your baseline is extension of the 2017 tax cuts, but really marginal impact for GDP growth in 25. Is that right?
In 25, that's right, in part because it takes a while for a fiscal package to actually come together and for that to be passed and for that then to be implemented. So whatever happens on the fiscal side is probably a bigger issue for 2026 than for 2025. As you say, we're looking for extension of the 2017 tax cuts. We have some tax cuts on the personal side on top of that, maybe something around state and local taxes, something around perhaps tips and overtime income, which is something that Trump talked about during the campaign. And then probably some tax cuts on the business side as well. We have a 15% corporate tax rate for domestic manufacturing. So not broadly speaking, we think corporate income taxes probably stay the same, but maybe a smaller tax cut for manufacturers, and then perhaps some more generous depreciation allowances as well. And then there are going to be some pay-fors, probably. We are in a very high deficit environment. The pay-fors, we think, are going to be healthcare subsidies and probably some scaling back of the IRA subsidies, especially on electric vehicles.
So I'll get to tariffs in a second, but just on the pay-fors and the debt and deficit, I know that the incoming Treasury Secretary Scott Bessent has talked about 333, trying to get deficit to 3%. Where do you see this realistically when we talk about the U.S. fiscal position, both in 25 and beyond?
In terms of the size of the deficit,
exactly.
I think it's going to be very difficult to get down to 3% in terms of the federal deficit as a share of GDP, let alone the general government deficit, which, of course, from an international perspective, you would generally look at general government deficit. That adds another, probably percentage point or percentage point and a half. But we're closer to 6, even on the federal side. Maybe we can bring it down somewhat below 6, but I think it's going to be difficult to get down to 3. On the growth side, I wouldn't rule out 3% GDP growth. We have seen GDP growth close to 3% in the last couple of years. My forecast is somewhat below that, but it's not massively below. And then I think on oil production, yeah, I do think that's possible. We could probably see further increases, maybe as many as 3 million barrels a day. But on the deficit side, I think it's going to be quite hard.
So let's talk about risk to the outlook. I was struck in your note that came out, I think it was November. You said the biggest look to the risk to the US outlook were tariffs. And I'm just wondering, one, has you changed your thinking on that at all since post-election, given some of the threats we've seen from Trump since? And how do you price in the day-to-day threat of Canada, Mexico, 25%? How do you work that into your models and your thinking?
It's a great question. It hasn't really changed fundamentally because we still are left guessing what is actually going to be implemented. I do think it is a significant risk because it is clearly something that Trump feels very strongly about and has done for many decades. And you can document this really going back to the 1980s. It's something that is, to a large extent, under his control. So you have to take it quite seriously. It doesn't mean you have to take everything entirely literally, but you have to take it seriously in a broad sense, because this is something that the White House gets to decide because Congress has effectively ceded its authority on trade policy to the White House over the decades. Now, what are we assuming? We're assuming, I would say, a modestly benign outcome with increases in US tariff rates on China, averaging about 20 percentage points, as much as 60 percentage points in some areas, but not 60 percentage points across the board. That would be a very inflationary outcome. It would be very, very salient, I think, for consumers to see the inflation impact of a 60 percentage point increase on consumer goods. We have 20 percentage points, and then we're looking for auto tariffs on the EU, as well as EV tariffs on Mexico. And that gives us a hit to growth just from this part of the policy package of maybe 0.3 of a percentage point, 0.4 of a percentage point, that kind of number concentrated in 2025, because I think Trump will basically come out of the gate pretty quickly with those tariff announcements. The risk case is one in which you also get an across-the-board tariff of 10%. He's even talked about 20% at times. But even a 10% across-the-board tariff on top of these China tariffs would be quite significant. If you take the overall effective U.S. tariff rate resulting from those kinds of policies, this would take us back to the 1940s. So effectively undo the whole trade liberalization process, at least as far as U.S. tariffs are concerned, that we've seen in the post-war period. That's not our best guess. This is not what we're building in, but it's something we're watching. And then there are a bunch of different scenarios that are a little bit more in between. In terms of the effective tariff rate, for example, if you took the Canada and Mexico tariffs literally, that would place you somewhere in between our base case and the risk case. And of course, there's an infinite number of other potential scenarios.
But you have modeled it, the Canada-Mexico tariffs, the 25%, just in theory, if they would go into place.
You have. We've modeled, we certainly modeled the risk case. That would mean, a GDP hit of 1 percentage point plus. It depends on what would happen with the extra revenue. That's an important factor here. If the extra revenue is recycled into tax cuts, then the effect would be a little bit smaller. If the extra revenue is not recycled into tax cuts, then there would be a fiscal tightening effect on top of the, perhaps trade policy uncertainty and, financial market effects of tariffs, which we saw in the first Trump administration. Those are already negative by themselves, but there are a bunch of permutations. If you had Canada and Mexico, I think that's probably somewhere in between the base case and the risk case, though with some obviously very important economic geography effects that go beyond the sort of pure macro effects that we get from calculating the effective US tariff rate.
On the China front, have you identified specific exports that could be targeted on the 60 versus the 20? I agree with you. I don't think it's going to be the 60 across the board. But have you pinpointed out where the 60 could happen versus the 20?
Yeah, so we have a range from 5 percentage points to 60 percentage points. And basically the lower numbers are direct consumer goods, iPhones, other consumer electronics, and the 60 would be the lists 1 and 2 from the first Trump administration, which are predominantly capital goods and intermediate goods. We have, listed it all, though, of course, in the end, I'm sure it'll be something that won't exactly correspond to what we've listed. But I'd like to write down baseline scenarios, and then we have a benchmark to compare the actual policies to.
Well, let's talk about inflation in the US. You mentioned inflation and tariffs potentially having an impact on inflation. Where do you see things headed? Things have been a little stickier than maybe forecasted a few months ago. I think you've targeted the Fed coming down to 3.5 to 3.75 on the Fed funds rate. Is that still your call? And do you see anything different in the normalization, the Fed cutting cycle throughout the course of the year?
Yeah, so obviously a lot of these things have been in flux. If you look at what market pricing has done since September, around the time when they delivered the 50 basis point cut, at that time, markets were pricing the terminal federal funds rate at 2.7%. Now, markets are pricing the terminal federal funds rate at about 4%. So it's been a 130 basis point upward revision in market pricing for where the funds rate ultimately ends. And I agree that on net, since September, the news flow has been a little hawkish, but not nearly to the degree that is priced in markets, in my view. We have gone from three and a quarter to 3.5 to basically 25 basis points more than that, 3.5 to 3.75. And the reason why I now have a dovish view relative to market pricing, unlike back in September when we had a hawkish view, is basically threefold. One, the funds rate's still quite high. 4.25 to 4.5% is above most people's, pretty much everybody's estimate of where the longer term funds rate is going to be. The Fed's own projection is 3. Ours is, maybe 50 basis points higher than that, but we're well above that. Number two, and I think this is very important, I'm optimistic on growth, but the activity measure that matters for the Fed is really more the labor market than GDP growth. And you can have these things, I mean, they're related, of course, but they can move in opposite directions. Over the last 2 years, for example, we had GDP growth of almost 3%. But nevertheless, the labor market's clearly rebalanced. It's gone from very overheated in early 2022 to now broadly in balance and probably still softening. We'll see. We'll get an employment report tomorrow, so there'll be an update on this. But the labor market has gone back into balance and now is maybe even looking a little bit soft in some areas. For example, the hiring rates come down quite a lot. So that also then plays into inflation. It's a reason for me why I think the trend in inflation is probably still downwards. There are risks to it. Certainly tariff risks are important for the near term. But then again, tariffs are more of a price level mover than ongoing a source of ongoing inflation. So we're expecting that if you take core PCE inflation, that goes from 2.8% in the most recent reading as of November to 2.4% by the end of this year. And of that, about 30 basis points is tariff related. If you took out the tariffs, which you might want to do in some, depending on the purpose, because it's a price level effect, then we'd be at 2.1%. So I'm still fairly comfortable, and I think I have a more optimistic view probably than at least many market participants that have taken a more hawkish view on the Fed outlook. Time will tell.
And I think your view aligns with what we heard from Governor Waller yesterday. He gave a speech at the OECD. We are going to have him here at the Atlantic Council in February after the next Fed meeting, so we will be able to reassess in a few weeks what he says. But how do we reconcile what you're saying about the more dovish outlook with what we're seeing, the movement in the 10-year and the yields? I mean, this is just strange from a kind of macro 101 perspective. You have the Fed cutting, but look at the movement in the 10-year, and I think a lot of people have been scratching their heads trying to understand what the market is pricing in here.
Yeah, I think there are two things. I mean, one is what matters for the 10-year is a little bit less whether the actual federal funds rate moves, in a particular way right now. It's really more about what federal funds rate is priced for the sort of intermediate term, and the fact that markets have upgraded their estimate of the terminal funds rate from 2.7% to 4%. That's directly relevant for the 10-year yield. So at least for the first several years of the term structure, markets are now expecting a significantly higher federal funds rate than they did 3 or 4 months ago. And that feeds directly into the 10-year yield. On top of that, there's also, I think, been some upward pressure on the term premium, the compensation that investors demand for holding 10-year securities as opposed to investing overnight. And that upward pressure, it could reflect a number of things. Maybe generalized policy uncertainty could certainly be a reason for it. The other obvious reason is that what we talked about earlier, the budget deficit remains large, and it's not obvious how it's going to come in. So we're going to get probably further increases in the debt to GDP ratio, further increases in federal government interest expense, and that's going to probably persuade investors to demand a higher risk premium over time. And I think this trend probably still has some ways to go. So while from a short-term perspective, 4.7% does look a little high, and certainly our strategists are looking for some reversal there. If I look out 3, 5, 10 years, if we don't get a more sustained budget consolidation, I think the upward drift could continue on a longer term basis.
Okay, so we have about 25 minutes left, and I want to start our tour of the world, Jan, and I want to start in Europe. You have a pretty weak outlook for the Eurozone. I think it's at 0.8% across the Euro area, slightly below the IMF forecast, but not far from it. Walk us through your thinking. And France and Germany, I imagine, here are some of the big drivers of where you see weakness in the Eurozone.
Yeah, so we're above consensus for the US, we're below consensus for Europe, and then outside the US and Europe, it varies a little bit more, and we'll get into that. But on Europe, we're definitely more negative on GDP, and I should just say as an aside, from a cyclical perspective, if you look at the European labor market, it's actually pretty good, and we don't have it weakening dramatically. But we do think that GDP growth is going to continue to be pretty slow. Some of that is just long-standing productivity growth weakness in the euro area. Many structural issues, the fact that a lot of European economies are quite strong in the technologies of the present and maybe the recent past, but not so strong in the technologies of the future. I do think that technology accounts for a large part of the gap between the US and Europe in terms of productivity growth over the past, say, decade or so. And I don't see that changing very quickly. That's number one. Number two, China has gone from being a large tailwind, especially if you look at Germany. Germany benefited enormously from China's integration into the world economy, especially in the 2000s. Was a large market and not much of a competitor, because the technological gap between Germany and China at that time was still very, very large. Now, China has caught up in a lot of areas. Demand growth in China has slowed, and at the same time, China is becoming a much stronger competitor for Germany, and the automobile space is the obvious example. And I think that's going to continue to be a headwind as well. And then you've got the trade policy uncertainty and the potential for an across-the-board tariff, and the likelihood, in our view, of auto tariffs. All of that, I think, is going to weigh on European growth. The politics is complicated. I think I agree with you that France will continue to be a source of uncertainty, and I think it's a downside risk that there's a lot of uncertainty about who will take over in 2027 when Macron's term comes to an end. In Germany, I actually think the politics are perhaps a reason for some improvement, just because we're in this malaise at the moment. We're going to have a federal election on February 23rd. There's very likely to be a change in government, and after the election, depending on the outcome, there's some chance that the infamous German debt brake, which I think is a sort of excessive, in my view, constraint on using Germany's fiscal space, that's going to be loosened a bit. There's a lot of politics that goes into that, and it's going to be close probably in terms of the election outcome. But I think there's a reasonable chance that we'll see at least some loosening.
This would be a significant development if they could finally loosen the debt brake. So we will check in on that with you, Jan, when and if it happens.
Depending on the extent. I mean, we're not building in, a huge change, but at the margin, I think there's a bit more consensus that perhaps the constraint is a little bit too tight, and 0.35%, which is a very strange number, 0.35% structural federal budget deficit is probably, it doesn't have to be quite that small.
So what does that mean for the ECB then? I mean, where do you see the rate path for President Lagarde headed?
We're expecting ongoing 25 basis point rate cuts. There has been some speculation about moving to 50s kind of post US election because of the concerns around trade. We think they'll stay on the path that they're on. We have a terminal rate of 175. That's also a little bit below market pricing. And it's really driven by both the inflation side, the fact that inflation is moving back towards 2%, and the downside risks on growth. So in some sense, it's a more straightforward story than what you have in the US. In the US, you have to, you think about the inflation side, you think about growth, you think about how GDP relates to the labor market. I'd say in the euro area, the main drivers are pointing to, further sustained rate cuts.
Do you think we're going to hit dollar-euro parity again, like we briefly touched in 2022?
Well, we're at 103, so it's certainly it's pretty close. Our forecast from an FX strategy perspective is not quite there, but I certainly wouldn't rule it out. And I do think that the fundamental, at least growth differences in our forecast relative to the consensus would point in that direction.
So I want to get to China, but before I do, I have to ask you about the UK, given the movements over the past few days. We obviously a lot of movement in gilt markets, I think related to fiscal concerns, but how do you see the outlook in the UK?
So UK, on the growth side, I would say it's been pretty volatile. We had very weak numbers about a year ago. Then for much of 2024, the GDP numbers were actually significantly stronger, and there was a question of how much of that you should really build into your estimate of underlying growth. We built some of it in, but then we took some of it out again because more recently it's been softer again. So, at the moment, we're, again, a little below consensus for UK growth by about half a percentage point for 2025, or just under 1%. What I've been more focused on is probably the inflation side, because while most advanced economies have seen a pretty similar, not perfectly synchronized, but pretty synchronized move back towards 2%, the UK is clearly lagging behind. UK inflation is still clearly above 3%, and that's been a reason for why the Bank of England's been slower in cutting rates. They're going every other meeting. We expect them to continue to go every other meeting. We do think, though, if I look out into 2026, lots can happen between now and then, admittedly, but we are further below market pricing for the UK than we are elsewhere, and think that bank rate will go down to the low threes ultimately, because in the end, we think UK inflation will also get down to something close to 2, although it is clearly taking longer.
But there's nothing that's happening this week in gilt markets that is reminiscent of what we saw a few years ago. It's not at that level from your perspective, right?
That would, yes. I mean, the Trussonomics episode, I think there were a lot of there were a lot of aspects to that, and of course, concerns around fiscal was one, and then there were a lot of market dynamics to do with LDI investing that I think don't exist in the current environment. But of course, we're watching it closely.
Okay, let's talk China. So I think your forecast for China is 4.5% GDP growth in 2025, fairly similar to consensus, where the fund is and some others. We at the Atlantic Council do analysis with Rhodium Group in partnership. We have it slightly lower than that in the threes, but walk us through your thinking of Chinese GDP growth. And I'm curious the moves the PBOC has made over the past few weeks, whether you see those as really stabilizing the economy. And how do you see them holding their powder dry? This is how some people are assessing the PBOC moves in case things escalate with tariffs and the Trump administration.
Yeah, so I think we're at 4.5%. That's basically a consensus view, and I think there are some positives and some negatives. But before I get into them, one point that I think is important is it's always hard to know what you should use as the benchmark for how the Chinese economy is actually growing. I mean, the official GDP numbers are imperfect, and they are, clearly smoother than what you see often in reality in some of the higher frequency indicators. And so one question is always, how quickly is the economy growing, and what are they actually going to print? And what we're forecasting is what they're actually going to print. I mean, I certainly wouldn't argue with the idea that true underlying growth may be as low as somewhere in the threes, but in terms of the official GDP numbers, we would be looking for about 4.5. There are puts and takes on the Chinese growth outlook. There are some very, very severe headwinds, certainly from the demographics, which continue to deteriorate, and the birth rate has edged down further, not quite as quickly, but it's still falling, and population growth is moving into negative territory. The downturn in the housing market. I mean, I think the decline in housing sales and starts, that's probably largely behind us, in part because we're down 50, 60, 70% from the highs. So that direct impact on growth is probably largely behind us, but the valuation adjustment is still ongoing, and all the ripple effects of a housing downturn, which we know very well from the post-08 developments in the US and other advanced economies. I think that's still working its way through the system. And then you have the trade policy uncertainty, the likelihood that there will be increased US tariffs on China. All of that, I think, is negative. In terms of the positives, yeah, it's mainly that fiscal and monetary and property policy are being loosened. I do think it's interesting that long-term interest rates have come down pretty dramatically over the past month or so. I take that as a sign that the economic policymakers and the PBOC are actually more serious about delivering stimulus. But I mean, that's what we're counting on.
And the movement in Chinese bond yields, I mean, what we see, it's the opposite of a US situation. Is that reflective of the downside risk?
Well, it is to some degree, but I think it's in part also a sign that the policymakers are basically encouraging expectations of easier policy. And if you have a decline in long-term rates in an environment where the growth numbers have been pretty soft, the inflation numbers have been very soft, and policy is clearly moving in an easier direction, you can take that as a signal that the environment is weak, or you can take it as a signal that the policymakers are trying to deliver stimulus. And I think it's probably a little bit of both.
That makes sense. Okay, I have one more question on EMs, and then I'm going to turn to our audience questions and get in as many as we can. So please use askac.org, and we'll get to them in the final 15 minutes we have here. Jan, EMs, bright spots you see. I just want to end this part of the conversation on a positive note. Are there things we should be looking for surprising to the upside?
We don't have major upside surprises out of EM in 2025. We are very constructive on India from a longer term perspective, but there is a breather. Basically, India is taking a bit of a breather after a very strong period of growth. And you can see it in the real economic data. We think growth will be around 6, so a little bit softer after a couple of years of much stronger growth. We also think that policy is moving more cautiously. The financial markets have taken a little bit of a step back after a period of very strong gains. But from a long-term perspective, the growth potential in India is still very, very, very strong. Latin America is going through a difficult adjustment period. Brazil, obviously, very much in focus in terms of the renewed, pretty aggressive tightening from the central bank in an environment where actual inflation has picked back up a little bit, but it's really mainly about inflation expectations and the currency. But it doesn't look like Brazil is going to be strengthening anytime soon. They've been pretty strong. The real economy is actually doing pretty well, but I wouldn't necessarily expect acceleration. Mexico is Mexico is in a difficult spot potentially if there are actually U.S. tariffs. On the other hand, Mexico could also benefit from higher U.S. tariffs on China and basically reshoring or friendshoring of production out of China.
Right. And we see some of that happening with Mexico. And then the tension with USMCA renewal will be, do they have to limit some of that reshoring or friendshoring? So that will play out certainly over the next year.
There are significant upside possibilities, but also downside risks for Mexico. It's going to be an incredibly interesting economy over the next couple of years.
Agreed. Okay, so let me get to questions here that I have online. First, Mark Niket from Bloomberg asks, how much economic growth are you expecting from deregulatory actions in the Trump administration?
It's a good question. We are building in a few tenths of additional growth, mainly from business investment, from basically increased animal spirits. And this is driven by expectation of easier regulation as far as M&A is concerned, as far as probably energy production is concerned, and potentially financials. So these are very important developments from an industry perspective. From a macro perspective, they're going to be diluted somewhat because you're effectively dividing whatever impact you get by 29 or 30 trillion dollars US nominal GDP. And as I often like to say, almost any number you take becomes kind of small when you divide it by 30 trillion dollars. But we do have it as a positive alongside fiscal policy, offsetting some of the more negative effects from tariffs and potentially immigration.
So this ties in a little bit to another question. This is from David Lynch from the Post, and he asked about outlook for foreign investment under Trump. One, he talks about hangover from the Nippon Steel situation. So does that curb foreign investment and interest in foreign investment? But then he talks here about there's the promise on easing and permitting. You talked about deregulation. Does that increase interest in foreign investment in some way? And could there be a deal vis-a-vis China in some broader package with Xi when you think about the foreign investment outlook for 2025? U.S. direct investment abroad? I think what he's asking here is outlook for foreign investment under Trump, countries investing in the U.S.
Yeah, I'd have to think more about the sort of different puts and takes here, because there are a number of different considerations. I don't know what the net effect is going to be in terms of foreign investment inflows. I do think in some areas, if you, for example, have a lower tax rate on domestic manufacturing, that could be a reason for increased investment. But and all of that can then also have some currency effects. I mean, it brings us back to the parity discussion, which then can have repercussions on the attractiveness of investing in the U.S. because it basically becomes more expensive if the dollar appreciates. So I think there are a lot of different effects in both directions. So I don't have a very strong view on this.
Another question here about the Middle East and geopolitical uncertainty, how you're pricing that in for 25 and how it impacts commodities.
So on commodities, we have generally taken a relatively range-bound view, at least as far as oil is concerned, with a $70 to $85 per barrel range for Brent crude. And there's been a bit of an increase in oil prices recently, and I think some of that has been driven by sort of spillover from gas, basically very low temperatures in some parts of the world that have pushed up gas prices, that encourages some substitution. But there's also, the perception of risk of greater military escalation in the Middle East, and I think that is an upside risk. We'll see what the Iran policy is going to be in the next, well, maybe as soon as the next several weeks, but probably in the next several months. That's going to have an important impact. There's, of course, Ukraine and Russia in the mix, and what does that mean for for global energy markets? But yeah, I mean, our baseline would be that there are, again, positives and negatives on oil prices, and our baseline is still that range.
Let me get to a question here from Jeff Brown. He asks about AI and productivity growth. Is this boosting at all US GDP forecast in your mind in 25, or maybe beyond 25 is when we really start to see some of the gains?
In our forecast, beyond 25. So we've taken an optimistic view on the impact of AI on growth, but with a longer time horizon than 2025 or even 2026. We did boost our potential US GDP growth forecast for the early 2030s by 40 basis points. And so that's a pretty meaningful adjustment, but it's still, but we think the main impact on the real economy, at least on GDP growth, is probably still a few years away.
That's early 2030s, you said.
Yeah, I mean, that's the peak impact on growth from the transition. It starts in our forecast in sort of 2027 or so. And of course, we look closely at the adoption numbers that we see to update those forecasts, but that's been our timeline.
Okay, I'm going to take two more online questions, and then I have a concluding question for you, Jan. One, I'm going to bring two together on China. One is about how you're pricing in for Chinese GDP growth, Trump tariffs, when you have that 4.5% call. And the related question is the risk of China doing their own version of export controls. We've already seen some of this with rare earths, and how you price in some of those risks.
Yes, good question. We basically estimate that this 20 percentage point increase in tariffs on China is worth about 70 basis points off of growth in China in 2025, before considering offsets from easier policy. So we had a forecast for 2025 of 4.7%. We took that down to 4.5, basically because we think 50 basis points of the 70 basis point downgrade on the back of tariffs is going to be offset by easier policy. And then in terms of export controls, yeah, I think that is one of the ways in which China can retaliate. And I mean, there are a number of other things on the menu as well. Of course, there's concern about making life more difficult for US companies and Western companies operating in China. There are a number of geopolitical ways in which China can be less cooperative, more uncooperative with the West. There's the Chinese bond portfolio, which often comes up in these kinds of decisions. discussions, but export controls would be a very straightforward way of retaliating, and I certainly would expect some of that if things escalate.
Yeah, I think this is what we're all watching for closely. China has their toolkit is different to respond to the US than the first time around. They've been thinking about this more, it's clear, since 2017,
For sure.
2018.
Yes, I'm sure they have some things up their sleeve.
Definitely. Let me ask about crypto. We had a question online. Does this factor in at all to your forecast in 25? The Trump administration, of course, has promised to unleash crypto in the US. Any productivity gains from there? Anything you see currency-wise that's happening potentially in 25 or beyond for the US and crypto?
It has not had a major impact on our forecast. Obviously, we've seen huge price gains. The overall market value of crypto relative to broad financial markets is still relatively small, but you can calculate a wealth effect. And if you include crypto in that, this is going to add modestly to the wealth effect. I think that's the main way in which there's going to be an impact on the real economy from the demand side. I think in terms of really changing the way that finance operates, that's still much more open to question. And even if it did have a large impact, I think it would still be a long ways off. But we're not building in a significant shift.
One more online. We had so many questions before I had my concluding question, but I had to ask this one. I thought it was interesting. Are you worried at all about Fed independence in the year ahead, especially in the lead up to Chair Powell's end of term in May 2026?
Well, I'm sure we'll hear significant discussion and maybe tweeting and so forth. I mean, we've obviously seen the announcement from Vice Chair for Supervision Barr that he'll be stepping down from that position. So there will be a replacement from the current set of governors. I think in terms of Chair Powell's outlook, he will stay through the end of his term, and he's made it very clear that decisions are going to be based on the Fed's mandate, and that's my expectation. It's going to be driven by the outlook for inflation, the outlook for employment, and that's what we should all focus on.
Yeah, one thing we saw from the last time Trump was in president, when the markets reacted to his tweeting or perceived pushing of Powell in one way, he relented. We'll see what happens this time if we come to that. But there's one thing we know about Trump: he's market sensitive and sensitive to market movements. So we will see what happens.
And I think that's a broader insight that applies obviously to the Fed, but it also applies to tariffs. So it's certainly possible that we will see a more significant tariff announcement than what we have in our baseline at some point. But then if the reaction is negative, there could also be backtracking.
Good point. Okay, final question. I've asked you this 4 years in a row. It's the toughest question because by nature it asks for something that's hard to predict. But what is your black swan event, Jan? What is the thing we're not thinking about that we should be thinking about on the horizon that's a tail risk?
Always a tough one. I mean, the known unknowns are always easier to identify. We've talked about tariffs. I mean, we have many highly valued assets, and I think there are good reasons for high valuations in a number of areas in an environment that remains pretty constructive and has surprised a lot of people on the positive side. But if you were to interact a negative shock with with highly valued markets, you could get some pretty sizable drawdowns. And we have generally found that valuations don't do a great job by themselves in predicting what's going to happen to markets on a, say, 6-month or 12-month horizon. But high valuations do seem to predict bigger drawdowns in response to negative shocks. So I think that's something that we should certainly keep in mind.
Okay, that's one we will watch for. Jan Hatzius, I want to thank you again for joining us, kicking off our year always here at the Atlantic Council. I appreciate your time, your insights, your willingness to take questions on such a broad range of issues. And we can't wait to check in with you and keep our annual tradition going into 2026 and beyond.
Thanks so much, Josh. Wonderful to be on with you again, and I look forward to doing this again in the future.
Thanks everyone for joining us and tuning in. We will have a series of events coming up over the next few weeks. A week from today, we hold a special event on the future of economic statecraft with senior Biden administration officials. And as I mentioned earlier, Governor Waller will be here at the Atlantic Council in early February to talk about the future of the dollar. So stay with us at the Geoeconomics Center. Stay with us at the Atlantic Council. We wish everyone a pleasant rest of the day.